So I mean, I'm sure any of us on this call, this webinar that have, actually been part of a transaction, know that it's a crazy process, right? From LOI to diligence to negotiation to actually closing the deal. And as no surprise, there is a ton of guidance behind the accounting for these types of things. So, and by a ton, I'm talking like thousands of pages of, US GAAP guidance. So for the purpose of this and the way that you should think about it from as you think about accounting for a business combination, we try to break it down into five simple steps, right? So first off, the question being, is it a business combination, right? The second step is when you do determine that it is a business combination under US GAAP, you got to figure out what you pay for it, right? So it's, do you pay cash? Are you paying other items as part of the transaction? The third step, once you know what you're paying, is what are you getting from it, right? So when I think about what are the assets that you are acquiring through this deal, what are the liabilities that you're taking on through this deal, that tends to be, a large part of the project is just knowing what you're getting, right? So now we get to step four, right? So now you know what you paid, now you know what you're getting, and the last piece is, well, how do I make all of that work? So we just get into the phase called purchase price allocation, PPA, that a lot of us have heard. And that leads into step five of saying, okay, what is the difference between these two? Do I recognize goodwill as the delta between these two pieces? Or in some very rare cases, do I have a bargain purchase gain, which is a fun little topic that we'll briefly chat about coming up here. So that's the way that I try to break it down into five simple steps.